Warren Buffett says it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Yesterday, when I was in office, one of my friend, colleague, he asked me, "Is this a good time? I have $10,000. Is this a good time to buy TD? What do you think about it?" Because I talked to him about the stock market investing a couple years ago. So he bought a TD years ago at around 50, $53, the stock price, but now it's above 76. So it's more than like 50% up now. So he's happy because the price is going up, but he always come back to ask, is this a good time to buy more? I think that's a good question. Honestly, I have no idea. Why? Because he want to buy at the lowest price. That's the real question, which I don't think anybody can answer this question. But if we look at what Warren Buffett said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I want to talk about my experience because I invest a lot in Canadian banks. In Canada, they have five big banks, and I prefer TD. And I already announced I'm going to invest $5,000 from my investment cash flow every month from start next week, which is August 2018, and I plan. Uh, the plan is for 20 years, next 20 years. Okay, I want to talk about a little bit about why I selected TD. Okay, first let's have a quick look. This is a website you can search the Canadian stock total return information. Okay, I just looked at the past 5 years. So in the last 5 years, TD stocks the average annual return is almost 16%. And I will check BMO. It's 14.5%. Royal Bank, 14%. And the Scotiabank, less than 10%. And CIBC, 12%. So the question is, everyone is in the same industry. They are all in the same banking service industry. Why TD has higher average annual return for the past 5 years? Charlie Munger, Warren Buffett's friend, best friends, said, over the long term, it's hard for a stock to earn a much better return than the business, which is the underlying it earns. If the business earns 6% on capital over 40 years, you hold it for that 40 years, you are not going to make much difference than a 6%, even if you originally buy it at a huge discount. If a business earns 18% on capital over 20 or 30 years, even you pay an expensive looking price, you will end up with a fine result. I think this is very difficult. Even after years, I had investing in the stock market. I totally agree, understand the concept, but it is still very difficult when you actually apply the investing principle into your own investment. But this basically tells you, let me explain the in common sense. If you own a business, the business make like 20% return every year, and then if you hold it, most likely you get long term you get 20% return on your investment. If the business it own only can make 10%, then you get 10% from a long term perspective. And this is how an investor should think about a business. I mean, if you want to be a business in the stock market, then you have to have a business mind. Of course, most people, they don't want to have, or they don't want to use business mind to think about stocks, because they chase price up and down. So they pay very little attention to the business itself. So if you look at the TD Bank chart, the long-term trend is always going up. So when my friend asked me when is the best time to buy, that's tough, because every time he comes to ask me the same question, the price, most likely the price always much higher than last time he asked me. So for myself, for the next 20 years, I will invest $5,000 per month into TD stocks, because my plan is to purchase every month. So most likely, every time I invest my money, I will pay the highest price, because the stock market, the TD, stock price is always goes up. So every time, if I want to purchase more TD stocks, I will pay a higher price every time. So most likely, I will pay higher price every time. But why I still expect a good return from this? That's because Warren Buffett told me it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I want to invest my money into wonderful price, also at a fair price. Of course, if I can get a wonderful price, it's even better. But normally, a wonderful company never cheap. So I would rather to pay a fair price for a wonderful company, because the chance to purchase a wonderful company in the stock market at a discounted price is very rare. But even I never ever can get a wonderful price for my investment, as long as the company I invest is a wonderful company, and I'm only pay a fair price. It is okay. I still will have a good return. I want to talk about this because a lot of people, when I talk about, I learn a lot from Warren Buffett and Charlie Munger, the greatest investor in the world, in the whole world. Some people always laugh at me, say, these guys are billionaires. You are just a small potato, have a couple $1 million. And what you can learn, they are talking about which it's 10 years, 20 years, 30 years. You know what? My experience tells me all these are the basic investing principles. Most people never really think about and understand, because they never understand it. How can they apply it into their real investment decision-making process? I want to explain, when I make my decision, I want to invest in TD, what the basic common sense, the basic investing principle I learned from Charlie Munger and Warren Buffett, and I applied into this investment decision making. Because I look at this from Charlie Munger tells me it doesn't matter which price you pay. I'm not saying it's a very overpriced. It just see if you pay 5% more or 5% less, it doesn't matter. The most important thing is whether this business can earn a good return on capital over the long term, which I believe TD has a chance as a business still can earn a good return on the capital for the next 10, 20, or 30 years. This is how I apply Charlie Munger's investing principle into my own investment. Also, for Warren Buffett. Warren Buffett always suggests to buy a wonderful company, but wonderful company never get a discounted price. So you need to accept it. Wonderful company at a fair price. If we look at it, this is the Morningstar.ca, okay? So if I look at the financial numbers, even TD today at around $77, this is the highest price in history. But based on the valuation, the business, the earning, power, it's still a reasonable, a fair price. Because if you look at it, the forward PE is only about 11.4. And you check the valuation, it pretty much is still at the average level. So it is, even it is the highest price in history, it is still at the fair price level. But you need to have a business in mind to look at the valuation, to look at the business itself. My friend only look at the price. That's why every time he only asks me, is this a good time to invest again? Because he looks at the price and he doesn't know what to do. But the investor, with the basic investing principle knowledge, you should realize at today's price, TD is still at a fair price. Last, I would like to show a number here. Okay, this is the TD website. The TD website, the investor relationships. They have a tool. You can calculate the investment return, total return. Okay, so I put a number here, $81,000. Why I put $81,000? Because $81,000 is the average household income in Ontario, Canada. So this is the average house income number, $81,000. And I selected 1993 to today. Why I select? Because 25 years. Why I use 25 years? Because this is 25 years normally your mortgage contract is 25 years. So if you look at this, put a 1 year salary, 1 year family income into TD stocks, in 25 years, you will have $3.5 million. This is, so for 25 years, you put 1 year income into TD stocks. In 25 years, the total return is more than your 25 years salary. You really need to think about it. Because this, the first time when I realized that, it surprised me. I still have a mortgage, and I already told everybody I'm I'm quit. I will quit my job next month, and I still have a mortgage, and I never ever want to pay out my mortgage. I can, if I want, I can pay right away tomorrow. I only want to pay the interest. Right now is about 3.15%, I believe. I told my agent at the bank, say, I don't have any plan to pay back principal. I only make sure I pay the, the interest. And I always take back the money because you can use a home equity line credit, right? So I always take back my money. I only make sure I pay the interest only. Why? Because let's say if I pay my mortgage, so in 25 years, I I pay all my mortgage, and I don't have any uh, mortgage balance anymore. So I own the property. But if I only pay the interest, after 25 years, I still have a mortgage. However, I invest all the money, I can pay the principal of the money into a TD stocks, how much return I can get. This will be far more than the property value in the market. Plus, even I don't pay out on my mortgage, I still is the owner of my property. If the property price double, I still can take the profit, no problem. This is why I decided I will invest my money first, and everything else is second after that. I always, okay, this is also the one rule the rich people do all the time is pay yourself first. So how I pay myself first? Every month, when I receive my dividend income from my investment portfolio, the first thing I think about how to reinvest. Before anything else, I think about reinvest first. This is my way to pay myself first.